Aha, I can see you jumping for joy. You got through the movements. Congratulations, that's fantastic. But I can see we've just got a skeleton of a idea of what we're doing here. I see a little frame, but not much on it. Maybe we should add a little meat to that thing right now. It'll give you a little more information of how to count. Oh, got your intention, sitting up, paying attention. That's great. So, I did say we're going to put a little meat on, not too much. And the way we're going to do it, we're going to do it by looking at an indicator. The indicator is called the Traders Dynamic Index, TDI for short. And it's in this part of the chart right down in here. Okay, so let's separate it from the chart for the moment, and here it is. The parts we're going to be looking at, we're going to start off by looking at the green line on this chart. It's right here. Goes up, goes down. That green line, it's called the RSI. RSI is the Relative Strength Index developed by J. Wells Wilder. Something you can find out about on the internet anytime you want. It's a momentum oscillator that measures the speed and change of price movements. Oscillator goes between 0 and 100, and it's traditionally considered overbought when the RSI is above 70 and when the RSI is below 30. Okay, so the green line of the RSI is the fast-moving RSI. There's also another one on here, the red line. You can see this little red line in here. It follows along with the green one. It's another form of the RSI, except it's a smoothed out one. It's an average, so it's a slow-moving RSI. All right. And then we're going to also look at the blue lines. These blue lines, see them going out here? They're similar to the Bollinger Bands. Essentially what they are is a standard deviation of the past movements in the RSI. What that means is that if they just take the average of a certain number of last bars of the RSI and they go 2 or 3 times that, the blue line shows how far it would be, 2 or 3 times that value of the RSI. Okay? And then they're just used to indicate volatility. The wider the bands, the more volatile the price action, the more the price is moving one direction or another. And conversely, the closer the lines are, as in here, the slower the price's action is. Okay, price isn't moving quite as much. Okay, so when the RSI goes outside the bands, that indicates extreme volatility. You can see where it came down here or went up there. Coming outside the bands, that shows extreme volatility in price. The yellow bands are called the baseline. This is this part right here in the middle. Okay. Okay. It's the average value of the 2 outer blue bands right in here. Okay. So essentially what this is a moving average, or 50% of what the blue line should be, versus the static 50 line that the RSI has. The TDI, this entire indicator, takes an average value of the blue bands and plots it as this yellow baseline. We'll be looking at 3 different ways how price and the RSI interact, along with the variations between their action and the outer bands and the baseline. Okay, we'll be looking at 3 different ways. The ways we'll be looking at divergences, something you've probably been kind of familiar with. I'm sure you've heard about it before. We'll also be looking at to see how they interact with the baseline bounce. And the final thing we'll be looking at is how they create a reverse divergence, something I'm certain you haven't heard about before, but is quite useful. So the first thing we're going to talk about is divergence. It's probably something you've already heard about. Essentially what a divergence is, it indicates a change in the direction of price. And what it does is you get a price rises to a new high, but the RSI has a lower high. See, we have a higher high in the price, but the RSI is lower and did not go as high as the previous push too high. Okay? And we're expecting price to come down. See, divergence, we get a higher high in the price, a lower high in the RSI, and we're expecting our price to change direction, to come down. Opposite, of course, happens if you're going down, you expect the price to rise up. Okay? Now there's also another type of a divergence with the RSI when one of the bands is outside the bands. I'm sorry, one of the readings is outside the bands and the other is inside the bands. Let's see. That's like we have on here. See how the RSI line came way outside the bands, but the next one stayed inside the bands? That's another type of divergence. Like over on this side, you can see we've got a high, then a higher high. We have a high way outside the bands here, another high that's inside the bands. Now if this RSI that was inside the bands came up to the bottom of the bands, it didn't really go through it, and it's still higher than this one, because you have an outside the bands, inside the bands situation, you would still have a divergence. Okay, it doesn't always have to be below when you got one outside the bands and one inside the bands. Alright. So that's what it's like on that particular situation. So then, let's go forward and we're going to look at the baseline bounce. A baseline bounce usually shows a continuation in price, like with the price coming up and pulled back, and then the RSI bounced off the baseline. Boom, went off, the price went up. Okay, a baseline bounce shows a continuation in price, off of it and up. Okay, sometimes it'll show an extreme in the price, like if you've got the price coming up and it went up higher, and the RSI line came below the baseline, it came back up, as in push 3, it came to the bottom of the baseline and bounced off it down. That's where you can get an indication that you have an extreme on your push 3. Okay, so generally what we use is RSI bouncing off the baseline, or baseline bounce. It goes in the direction price should go. The RSI bounces off the baseline in the direction price should go. That's what we'll be looking for. Okay, the next thing we'll talk about is the reverse divergence. A reverse divergence indicates a continuation in the direction of price. Now this is a term I made up myself. Reverse divergence. I could have called it a continuation divergence, because it's supposed to have the price continue in the same direction, but its abbreviation would be CD, and we already have a movement with an abbreviation of CD. That caused confusion, so other people call it a hidden divergence, but it's not really hidden. It's right there in front of you. It's just how you interpret it. So for whatever reason, I came up with the name reverse divergence. Hopefully that won't come back and bite us later on, but right now we're stuck with it. So a reverse divergence indicates a continuation in the direction of price. Alright, what we have here is price went high, the price pulled back. It has a higher low right here than this low. Okay, but the RSI creates a lower low. See, when the push 1 pullback, RSI came here. The push 2 pullback, RSI line came below the push 1 pullback reading. Okay, so RSI created a lower low, even though the price was a higher low. So what you're expecting the price to continue up in the original direction, go higher. RSI line can go higher too. It can continue higher. It can just stop up here and give us a divergence. We won't know until we're in the situation. But a reverse divergence should show a continuation in the direction of the price. So a divergence shows a reversal in the direction of price. A baseline bounce can show you a continuation in the price going up, or it can indicate a change in the direction of the price. A reverse divergence shows a continuation in the direction of price. Alright, so I want to give you some of my observations and a little guidance on how to use these indicators, or how to use this indicator in these different situations. Basically, with a divergence, it's the most popular one out there. So many people teach it. The market makers know it cold. They know you know it, and they know it's one of the things you look for. So, as I showed you in the blog, that the market makers use your rules against you, they will use a divergence against you. It is the divergence are the least reliable of the three situations here. They'll give you many false signals of divergence. If you just look at the divergence and nothing else, you're going to burn through accounts like you wouldn't believe it. And you're going to get many divergences, especially in a push 2. Okay, and at times they won't even give you a divergence when you're at an extreme. If you get at a push 3, you're looking for a divergence in price, you're going to get a maximum reading on the third push up here in 3. It's going to be way past this. So where you're looking for it, you won't always get it. And where you shouldn't be getting it, you will get it. So just keep in mind that the divergences are the least reliable out of these 3 situations here. Now on a baseline bounce, they are most reliable on showing a push 1 pullback. You get a push 1, pull back, it comes down and bounces off the baseline and goes forward. That's where they are the most reliable, confirming a push 1 pullback. And they can also confirm a minor push 2 pullback or the extreme of a push 3. Like you've got on push 2 going up, you can have 3 sub pushes in here. On the pullback of the sub push 2 going into it, you can get a baseline bounce going up. Also, if you have 3 sub pushes going in up in push 3, you can get a baseline bounce off of this one, off this sub push 2 going up into the final push 3. Okay, and then of course, as I said, the final where they can also show the extreme of a push, as in push 3 up in here, they can come in and bounce off the bottom of the baseline. A clean baseline bounce has a probability of success between 60 and 65%. It's a heck of a lot better than what you're going to be getting in here. If you get 40% right, you're great. Over here, you're more than increasing your odds more than 50%. So the baseline bounces are much more reliable than the divergences. Okay, now let's look at the reverse divergence. Reverse divergences are usually found at the end of a push 2 pullback, as we have in here. The push 2 pullback is where they're usually being found. Which push 2, we don't know. But they can indicate the completion of a push 2 pullback. As I said over here, you can have 3 sub pushes going up in your push 2. They can mark each reverse divergence can indicate the pullback on that push 2. As in going into 3, you can have 3 sub pushes in here, and you can get a reverse divergence each one of these going long. So what you're looking for at any reverse divergence, you're anticipating or expecting it to mark the end of a push 2 pullback. And reverse divergences are usually around 70% accurate. They're the most reliable and most accurate of all the divergences. I mean, on all the readings of the RSI. Okay, now then, on the final consideration or observation I've made of these 3 uses of the RSI is that going into a push 3, you should see a reverse divergence and or a baseline bounce going into the final push 3. If you do not see a reverse divergence or a baseline bounce going into the final push 3, whether it's a pullback of 2 or the sub pullback of 2 going into 3, if you don't see one in there, you're probably not going to be going into your final push 3. You're going to be faked out. Okay, so be looking, going into your push 3, look for a baseline bounce or reverse divergence. If you do not see one, your count is probably off, and don't consider the final push a push 3. Alright, so let's see how these theories or ideas work in real life, and we'll use them and apply them in some charts we'll be examining. That'll be in the next video.